Hi everyone, welcome to today's video. So on today's video, I'm going to speak about 5 stocks that I feel could double from this point. Now, very important set of disclaimers. Number 1, this is not an investment advice. Number 2, I will be speaking about some dangerous stocks on this video. So in case you are faint of heart and if you want to only invest in HUL, HDFC type of companies, I have already made enough videos on that. Please do not watch this video. Please move on. Point number 3 is that these stocks will undergo volatility. So please aggregate them in case you are considering aggregating them only in small amounts. So with these disclaimers out of the way, let us get the discussion started. And let me first and foremost present my investment thesis in these stocks. So I'm looking for stocks that meet the following criteria. Number 1 criteria is that these should be market leaders in their space. These could be small cap, large cap. I'm not too worried about them, but these should be market leaders, because if a company is a market leader and that industry is growing, and if the company stays as a market leader, very good chances that the stock price will double. Second key point, the firm should have specific growth opportunities that should be visible to us at this point in time. So these two are my investment thesis, based on which I have picked 5 stocks that I will be speaking about. I will have to be quick on this video to condense everything in 20 minutes. In case you want me to make detailed videos on any of these stocks, let me know. I'll be very happy to shoot detailed videos. Also, this video has been sponsored by Vested. Vested is an excellent platform for US stock investing. You can consider checking them out. They are currently running a contest where you can participate, and if you perform really well on that contest in terms of investing, there are cash prizes to be won. So you can go check the links in the description box. More about them subsequently on the video. So the first stock that we will discuss about is Zomato. So the moment I say this, there will be a lot of people who will be commenting a lot of stuff about Zomato. So please listen to me holistically. I will present both the pros and cons of this stock. So the first interesting fact about Zomato is that it is valued at roughly 36,000 crore. So 36,000 crore, very big company. You will be super impressed. But here is the interesting fact that Swiggy, which is its competitor, at the time when Zomato was getting listed, Zomato was 2x the valuation of Swiggy. So which means that if Zomato's valuation was $5 billion, then Swiggy's valuation was $2.5 billion. Now the interesting thing is that Zomato's valuation, you can see it is at roughly 36,000 crore. Now let me show you Swiggy's valuation. So Swiggy towards the end of January 2022 was valued at $10.7 billion. So how much is $10.7 billion or $11 billion in INR term? It will roughly be 88,000 crore. So at the time of listing, Zomato was 2x the size of Swiggy. Now Swiggy is more than 2x the size of Zomato in the unlisted market, so to say. So that is how valuations work. So over the year, Zomato's valuation had been crushed. It had been demolished. And I said that, I'll not be investing in Zomato's IPO. I made a lot of videos around that time also. And recently I have started to build some position in Zomato. And out of 10 installments that I'll be putting in this stock, I have only put 1 as of now. So I'm being very, very transparent with you. And these are the same things that I've said earlier also. So now comes point number 2, that even the critics of Zomato, they understand that the food tech industry is growing. And Zomato is expanding quite aggressively when it comes to 10-minute delivery, food tech, whatnot, right? So it is expanding into a bunch of different things. So to cut the long story short, it's not as if that Zomato is a weak player in a growing industry. Zomato's industry is very good. Even the critics of Zomato share understand it. Now comes the third point, which is around valuation. And this is where the story gets super complicated. So if you have to understand valuation, let's go back to Professor Damodaran's commentary and let me set some historic context, and I will analyze some of his recent tweets on this topic as well. So when the story started for Zomato, Professor Damodaran was of the viewpoint that, Zomato should be valued at roughly 42 rupees. And after that commentary from Professor Damodaran, Zomato stock actually rose by roughly 50% from the point where he had started giving that commentary, and he was proven incorrect for a little bit. At that point in time, I was completely with Professor Damodaran, and I also believed in the narrative that Zomato's stock price is highly overvalued. After that, it started coming down, and now it looks like that Professor Damodaran is completely correct. So that is the entire history of Professor Damodaran giving his viewpoint of that 41-42 rupees for Zomato. And now after that valuation has been achieved by Zomato, Professor Damodaran has now said that, hey, the correct price for Zomato is roughly 35 rupees. So let us analyze 3-4 tweets by Professor Damodaran as to why is he saying that. So here is the first tweet, and Professor Damodaran categorically says that, hey, you cannot compare a price in July of 2022 to July of 2021 prices. Right? So therefore, whatever valuation he had done for Zomato at 42, 41 rupees, He's bringing it down to 35. I will show you that tweet also. But this is a very important point. So the situation in 2022 is very, very different from situation in 2021. What is that primary difference? The primary difference is the inflation. So let me speak more about it by analyzing his tweet. But let us first analyze the second tweet that he has done. And what he has said is that, hey, there are good things and bad things about Zomato's business as of now. And he says that, for example, the good thing is sustained growth, a larger cash buffer. These are some of the good things that Zomato has been able to outline based on the recent 2-3 quarter results that Zomato has announced. What is the bad stuff? The bad stuff is that the acquisition with Blinkit had not gone well. The markets have reacted poorly, and there are a bunch of other issues. For example, lower take rate, worsening margins. Now, what is take rate? I will explain that in a minute. So the point is that over the last 3-4 quarters, there are good things and bad things that has happened with Zomato. So given a combination of both these things, first and foremost, high inflation in the economy, and second, that there are a lot of negatives that has come out with Zomato. So Professor Damodaran has lowered the Zomato's valuation in his books to 35 rupees a share. So is Zomato going to fall to 35 rupees? I don't know. Neither I am going to hypothesize as to what will happen with the stock. But here is my viewpoint on this entire situation, and I will help you explain a few of the basic points here. First and foremost, when you are betting on a business like Zomato, it is still a very nascent business. You are not betting on the present business model of Zomato. You are betting on the future of Zomato and what type of businesses it will enter. Just to help you understand that point more quantitatively, here is the revenue breakup of Zomato as per historic year per vertical. So what you will see is that this red line, this is the hyper pure red line, and the revenues for Zomato on this red line is going up, up and up. So Hyperpure becomes a very important vertical for Zomato. What does Hyperpure does? Basically, it provides logistics support. For example, fruits, vegetable, meat, all that stuff. It provides in a B2B model to restaurants. For example, if you're running a restaurant, you require a lot of supplies. Then through Zomato Hyperpure, you can order those high quality supplies. So Zomato is able to explore this opportunity, and it is betting big on this particular opportunity. Another related point, that even its core business, this is the blue line which indicates the delivery revenue, even here the revenues are going up. There is no problem in terms of the revenue. So then you will say that, okay, then why did Professor Damodaran give negative commentary? His viewpoint is that, hey, take rate have gone down. So what is the take rate? Take rate simply means that if there is a platform. So what is Zomato? Zomato is a platform. People come, you and I order food. Delivery boys and hotels give it to us, and Zomato in the middle keeps some commissions. So take rate simply means that if Zomato's business is, let's say, 5 crore rupees a day, then that amount of money flows through the platform. But how much money does Zomato get to keep out of it? That is what is indicated by take rate. So Professor Damodaran's viewpoint is that the take rate for Zomato has gone down. Okay, I completely agree, but here is another point to consider here, and the point is that we don't know to what extent Hyperpure will grow, not grow, what other verticals Zomato will go into, etc., etc. So basically, it's a highly evolving business, but its revenues are increasing and it is constantly venturing into newer areas, newer segments. Final point that I will talk about Zomato is the advertising spent as a percentage of total sales. So what you will see here is that if you zoom in on this graph, you will categorically see that it is reducing its marketing efforts day by day, which is a great sign for a market leader company. So this entire story is not clear that, you know what, go buy Zomato, go do not buy Zomato, but you need to understand that if you are investing in Zomato, or if you want to invest in Zomato going forward, you need to have a very clear thesis that volatility is going to be there. It's not a bad stock, it's not a bad business, but it is going to go through a lot of churn. Why? Because it is experimenting into new businesses. So if you are buying that stock from that particular perspective, it is fine. Otherwise, simply avoid this stock. Now with that said, let us now speak about a second stock, which is a slightly more stable stock, and it is that of Google, or in listed terms, it is called as Alphabet. So there are two charts that I will present first. These are very, very important. Even if you are not interested in US stock investing, do listen to this, because you can apply the same formula for picking some of the monopoly stocks and tech in India. So here is what you need to see, that first and foremost, Google stock has corrected by a lot. At its peak, it was trading at roughly $150, and in the last 1 year, it has corrected by roughly 16-17%. So the correction has happened for a mega company like Google. This is chart number 1. Now, point number 2 that I want to show you is that how soon a company like Google's doubles its revenues. So this is a very interesting number. So here, if you take a look at that, in 2009, it was generating 6.5 billion, right? So that's 2009. Let's go in 2014. So what was happening in 2014? So here is 2014. So it was able to double. Yes, almost double. Okay. So then move to 2019. Did it go to almost 24, 25? So this is 2019 and it has gone to 34. So again doubled. Now almost 2022 we are sitting. and it has already doubled from its 2019 numbers. So the point that I'm trying to tell you is that every time people dismiss Google, that hey, very big company, how will it double in size, all this stuff, it keeps on doubling in revenues. So 5 years from now, can Google double, and so would its stock price? So my bet would be a yes, that Google can actually double. It has a very strong business. It is still available at a discount, so to say. So yeah, you can understand from my tone whether I'm enthusiastic or negative about this stock. So now let me show you a few more graphics to present the entire story of Google, so it gives you a sense as to how to research this stock further. So this graphic will tell you there is a red line here, and then there are a bunch of other comparators to Google here. So this shows the market dominance of Google, or the market share of Google when it comes to search engines. That when it comes to search engines, Google has a monopoly. No one else is even close. Now, this is the second graphic and I have picked it from the balance sheet. And what you will see is that these are the segment-wise revenues for Google. And take a look at any of the segments. For example, Google search and bar. Has their revenue increased over the last 1 year? Yes. Pick another one. For example, Google Network. Has its revenue increased? Yes. So if you go to any segment, their revenues have increased and has been increasing over the years. So this brings me to the most important point and the most argued about thing about Google is that, hey, it's already a big company. Where is the next segment of growth for Google going to come from? So it is going to come from its cloud-based business. So if you have friends in tech, understand by speaking with them what is cloud-based business is. And here is a market study that was done as to the estimates of what cloud computing market size would be. So this is a growing industry, and you can categorically see that in 2021, this industry used to be roughly $380 billion. And take a look at 10-year forecast of this industry. It is absolutely mind-numbing, the rate at which the cloud computing industry will grow from this point. And the wonderful part is that if you study this particular column for Google, you will see that the highest growth rate for a particular vertical of Google has been the highest for the Google Cloud vertical. Now, this does not mean that you should sell your house and buy Google, right? Please don't do that. Please be sensible in terms of whatever you are buying. There are risks associated with this particular stock. So let me point out a couple of risks. So the first risk is that Google has been consistently missing the analyst prediction of growth. That analysts were predicting that Google will grow at 15%, but Google was only growing at roughly 12-13%. So that was a first problem with the stock, that it is not able to meet analysts' expectation. And as a result, its stock price also keeps on falling from time to time, which, if you think from another way, gives you an opportunity to buy stuff. Second key point, that Google's ad revenue is being challenged by TikTok, and TikTok is interestingly emerging also as a search engine. So a lot of money is flowing to TikTok that would have otherwise flown to YouTube. So Google is trying to solve this problem, but right now there is a good competition which is brewing between Google and TikTok. Now comes the third stock, which is a company called as Vaibhav Global, and this stock shot into prominence when Mr. Vijay Kedia bought this stock. This stock has undergone a lot of turmoil in the past. So let me show you a quick charting history of this stock. So you can clearly see that by approximately 2020, it was at 201. Then it shot to almost 5 times within a year. And since then, it has fallen by roughly 70%. So now comes the natural question, that has Mr. Vijay Kedia sold his stocks? The answer is no. He is very much an investor in this. So let me quickly show you his holding, and you can see that he has hardly cut his holding. He cut a little bit, then he bought it back. So he is very much an investor in this company as of now. Interestingly, since we are on the topic of shareholder pattern, let us quickly take a look at promoter holding. They have hardly cut it. What about FIIs? They have hardly cut it. What about DIIs? They have hardly cut it. So at least prominent investors are not cutting their holding in Vaibhav Global despite a 70% correction in stock. So now the natural question comes, that can the stock go from 300 to almost 600, 700? That will give you 2x returns. So let us quickly discuss that. So first and foremost, let me help you quickly understand what Vaibhav Global exactly does. So they sell bunch of different types of low-end jewelry, so to say. Now what is meant by low-end jewelry? You can take a look at this picture. And these are low-end jewelry. The ticket size of Vaibhav Global products would be somewhere around like $30, $20, $6. Why am I quoting in dollar? Because they mostly sell their product in the US. So this is an India-listed company where majority of the sale is done in US and Europe. Only 1 or 2% of the sales is done in India. So let me speak about one important point about Vaibhav Global as to what their business strategy is like. It is very simple. So you must have seen infomercials. In case you don't know what infomercials are, get up at somewhere at like 12:30 at night and and put on some random channels, and you will start seeing people selling some weird products. Those are infomercials. Half of our ads, and they will sell you stuff like that. If you go and buy this broom and even clean your clothes with it will get dry cleaned, right? So that is the type of stuff that they sell in infomercials. I'm not saying that Vaibhav Global is doing it, but that is what their sales strategy is. And basically what they do is that they run a lot of TV ads, infomercial type of stuff, and they do these bidding systems, bidding prices, and they try to sell stuff. They have also undertaken a lot of investments in OTT, designing specific ads, running different type of infomercials, whatnot. Now the interesting thing about Vaibhav Global is that its sales has been constantly increasing. You can see it from here. The profits in general are also increasing. So there seems to be no major problem with a company like Vaibhav Global. So then comes the natural question as to why did the stock price fall? So that's a long debate, long discussion. But one of the key reasons was that inflation right now in US and UK is very, very high. It is almost at its all-time high in the last 40-45 odd years. Very, very troublesome situation. Majority of the customer base for Vaibhav Global is in the US and Europe, especially UK, and it sells discretionary products. So as a result, the last 1 year performance of Vaibhav Global had been dismal. So that is one of the prime reasons why its stock price fell. Now again, if you need a detailed video, I'll be happy to make one. So now let's move on to the next stock, which is V-Guard Industries. I had already made a separate video on that. You can go and check it out, but let me recap some important information about V-Guard at this point. So first and foremost, it is a very well diversified product. For example, if you take a look at its product breakup of revenues, you can categorically see that they are visible across a range of different spectrum. They are building their product line quite intelligently. Additional point that if you take a look at their electronics, consumer durables, electricals, other type of businesses, they are doing fairly well. Net, they are selling durables. That's a simple point. For example, inverter is one of the key things that they sell. Now comes the second key point that if you take a look at the charting history and you check the current prices, it's at 225. This price existed back in 2017. Okay, so this is a 5-year time correction that has already happened on the stock. So let us quickly check if there is something fundamentally off about business. Is their sales suffering, profit suffering? So if you go through this, you will clearly see that hey, net they are doing well. There has been no problem in terms of sales. Even the profits are hitting an all-time high. So therefore, I see the stock going to at least 270, 280 levels, so to say. Now you need to understand this point in context of consumer durables. So the last 1.5, 2 years have been really bad for consumer durable companies, good companies. For example, Whirlpool, its stock has been crushed. Why? Simply because people are left with very little discretionary power. Interestingly, this high inflation debate, people not buying enough stuff, this, that, no, nothing of that sort is happening. The on-ground results are quite positive, but yes, there is one area where consumer durable companies are suffering. Due to high inflation, their material manufacturing cost has gone up, and as a result, that is eating into their profit margin. And some of these companies, for example, V-Guard, if you check the market cap, it is a mid-cap company. So these type of companies suffer a lot during the shrinkage of the economy, and that is precisely what is happening. It is not companies' fault. This is an industry-wide consumer durables problem. Now let me talk about two more data points. Number one, the small cap and mid cap companies have corrected more compared to Nifty. This is a point that I've spoken about a couple of days earlier. You can go check my video. So when the rebound happens in the market, and the rebound is already happening, it is very likely that small cap and mid cap stocks are going to outperform Nifty 50. Second key point, if you take a look at the growth prospects of V-Guard, it is promising because right now it has a lot of presence in South India and it is clearly expanding to North India. Additional point that if you take a 4-5 year view, everyone is saying that hey, the discretionary income in India is going to go up. Consumer spending in India is going to go up. So which type of companies do you think will benefit the most? It is exactly companies like V-Guard, because when people upgrade their living standard, the first thing that they buy is refrigerator, AC, fridge, these type of things, and companies like V-Guard are going to benefit from it. Now comes the final point, which has to do with in-house manufacturing versus outsourcing. And you can categorically see that the outsourced manufacturing, this is the outsourced one, this number is coming down with every passing year. Why is that? Because V-Guard is building its own manufacturing capabilities, and as they are able to in-source manufacturing and not give it to others, they will be able to improve their profit margins. Now comes the fifth and final stock, which is Relaxo. Again, if you take a look at the charting history, went up all the way to 1400 and then it has been crushed to approximately 980. So approximately 35-40% correction has already happened. Again, if you go and check the numbers, they have been able to increase their sales. No sales problem, no profit problem per se. profit numbers and sales numbers are the highest. So I do not see why this stock could be trading at less than 1400 if the markets completely recover. So this is the first key point. Second key point about Relaxo, again it has a very similar story to V-Guard. Now Relaxo is a discounted player company. Discounted player means that if you are buying a Relaxo chappal, what they are simply trying to do is that they are trying to give you quality product at very inexpensive prices. What does that indirectly mean? It simply means that they do not have a lot of pricing power, because if they increase the price of Relaxo chappal from let's say 150 rupees to 250 rupees, a lot of their base will go away. So that becomes a problem for them. Now, in a high inflationary environment, supply chain disruption environment that we have been speaking about, Professor Damodaran has been speaking about, these type of companies have gotten hit quite a lot. Why? Because unlike Hindustan Unilever, Relaxo does not have that pricing power. So this has been the primary problem for Relaxo, and as a result, the stock price has already corrected by 35-40%. Do I see it going down further? My viewpoint is no. So I do not see Relaxo going down substantially from this point. And why am I saying it? Because they have been able to constantly increase their revenues. They have been able to increase their profits. Plus, the thing that is working the best for them is that the Indian footwear market is approximately 75% still unorganized. So this study was done approximately a couple of years back. And at that point in time, Indian footwear industry was roughly 85% unorganized. Now there is no official data here, but the estimates tell us that the footwear market is still 75% unorganized, and a player like Relaxo has a lot of ground to cover and a lot of market to capture even from this point. In fact, my hypothesis goes a step further, that especially this crisis for a company like Relaxo has outlined the fact that they need to command pricing power, and they are moving into slightly more premium category. Very recently, they have done price increases for their product also. How are they going to do it? That remains to be seen. But net right now, Relaxo is not a bad stock. Again, not a stock recommendation per se. Please go and do your further due diligence. So you could consider my data points as points that you could further go ahead and research more about. I hope you enjoyed the video. Let me know in the comment box which is the stock that you are most bullish about. I would love to read your analysis, and I will see you soon.